Next problem on the list for Chapter 1 is E19. E19 indicates 5 individuals organized Miami Music Corporation, which I've abbreviated MM up here, on January 1st, 2012. At the end of January 31st, they had the following data. What the first requirement asks you to do is to complete, they give you formats, and I've kind of listed out this format here for 2 of the financial statements, and they want you to use that data to input the blanks in the financial statements. Simply what I want you to do is use this problem to get familiar with the types of components that are included in each financial statement. We kind of talked about the purpose of each financial statement in Chapter 1. That was mentioned in the narrative and in the context of the chapter. But I want to get you familiar with also inputting numbers in as well. So let's kind of go down the list and some of the informations that it gives us here. Okay. First one is revenues. Well, total revenues. We learned from even the last problem that we did that the income statement is calculated by taking revenues minus expenses to equal net income or net loss. So the revenues here, this 131, that's going to go right here, okay? Notice the heading for the income statement. We have the name of the corporation here, the type of financial statement that it is, and notice that it's for the month ended January 31st, 2012, okay? As opposed to at January 31st, 2012 for the balance sheet, okay? Remember that the balance sheet is a snapshot. It's a picture in time, okay? The income statement is through a period, okay? So that's why it's for the month ended as opposed to at a certain date or a snapshot, okay? Next one we go on here is operating expenses. Operating expenses that they give us is $90,500. And we'd subtract revenues. We'd take revenues and subtract out expenses. That gives us a net income here of $40,500. All right? Going down the list again, we have cash. Cash is going to go over here in the asset section. I believe it's $30,800. Okay. Next, we'll list out accounts receivable. Accounts receivable is $25,300. And we'll list out supplies. Supplies is $40,700. Giving us a total of $96,800. One thing to note here is that when you're working with the balance sheet, total assets have to equal total liabilities plus stockholders' equity, okay? So we expect these two totals to match each other or to be in balance, okay? Remember the accounting equation. Assets equal liabilities plus stockholders' equity. So this is one side right here, okay? This side needs to equal that side, okay? All right. So the next items that they give us over here is accounts payable. Accounts payable is listed at $25,700. And in stockholders' equity, they give us contributed capital at $30,600. Now, one thing that we have to do here, okay? One thing we have to do is calculate what retained earnings is going to be. Remember from one of your previous problems that we talked about. When you calculate retained earnings, you take the beginning balance plus net income minus dividends equals your ending balance retained earnings, right? Well, over here we've calculated net income, right? We've calculated net income, and it tells us in the problem that this company was organized on January 1st, 2012. So, if we're doing January 31st, 2012, what's the beginning balance in retained earnings? Your answer should be 0. So we start out with a 0 balance because they just got set up, right? They start with nothing in retained earnings. We add net income and then look down to the problem. Do they tell us anything about dividends in this instance? No. So we simply take our beginning balance, which is 0, plus net income minus dividends, which is 0, and that gives us retained earnings at $40,500. When you sum up this, and this, you get the same total well as the total assets, which is $96,800. So yes, our balance sheet is in balance. Total assets equals total liabilities and stockholders' equity. The next portion of the problem, number 2, says, did Miami Music Corporation generate a profit? How can we tell? Well, we can tell this by simply looking at the income statement, okay? Income statement says revenue, what was the selling price, what did you sell it for, and expenses, what did it cost you to generate the product or the service. The selling price minus the cost of the product or service, that gives us net income. As this is a positive number, as we have more revenue than we do expenses, we did generate a profit. So the answer is yes, and we could tell because of the income statement, okay? Part 3 says, discuss whether Miami Music Corporation will be able to pay its liabilities. Consider the relationship between total assets and total liabilities, okay? When we look at total liabilities, we see that the company owes $25,700. But when we look at the assets, we see that the company has enough assets to pay off the liabilities. Think about what these assets tell us. Simply by looking at cash, we can tell that we have enough cash. If we were the Miami Corporation, we have enough cash simply to take all that cash and pay off the liabilities with cash alone. But remember also, accounts receivable. Accounts receivable is the right to receive cash, right? So once we receive this in cash as well, that will add to the amount of funds that we have to pay off accounts payable, okay? A concept that you might hear when discussing whether or not a company has the ability to pay off its liabilities is current ratio. And we'll get into a few more of these ratios as we progress in the chapter. Ratio is a way to compare one company to the next. Think about when you are going to buy a car, right? You might compare how far the car can drive on a gallon of gas, right? To another car that you might buy and how far it can drive in a gallon of gas. We use ratios all the time to make comparisons. We use them in sports statistics for basketball players or football players and compare one player to another player. The same is true with financial statements and companies. We use ratios to compare one company to the next. The current ratio, which is a way of calculating whether or not we have enough assets to pay off the liabilities, is what we call current assets divided by current liabilities, okay? Now, you might be asking yourself, what is a current asset versus a general asset? We'll get into that when we talk about Chapter 2 in the classified balance sheet. Classified balance sheet splits up the assets and the liabilities between current and long-term. The general distinction is a year, and we'll talk about why the year, or 1 year, is a distinction between current assets and current liabilities. But for you, I just want to kind of preview that ratio for right now, and know that the answer to requirement 3 is yes. If you look to the balance sheet, you can see that the company has enough assets to pay off its liabilities. And I think that completes problem E19. Again, feel free to email me if you have any questions. Thanks.